What is crypto arbitrage? Arbitrage is a trading strategy that involves the simultaneous or almost immediate execution of two or more transactions of different directions. The goal of an arbitrage operation is to capitalize on the effective use of asset price discrepancies across different markets and trading platforms. Arbitrage is referred to as a strategy with minimal risk. For its implementation, it is not necessary to use price movements and predict the rate of cryptocurrencies. A consequence of the low risk level of arbitrage is also its low profit margin on trades. The strategy requires large cash investments to create working capital. Arbitrage operations include many different methods and options. Consider the main ones. Exchange arbitrage. The easiest way, which involves the fastest possible purchase and sale of the same asset on different exchanges or platforms. In the event of a divergence in prices for an asset, a trader buys a cryptocurrency on one platform at a conditional price of $100 and sells it for $101 on another. The $1 difference is the same arbitrage opportunity and market inefficiency that traders use. Triangular arbitrage. This type of operations involves the use of multiple trading pairs on one or more platforms. This strategy assumes that the trader has found pricing inefficiencies in the chain of speculative transactions. Let's assume that BTC USD equals $20,000, BTC ETH equals 0.05 BTC, ETH USD equals $1,010. In this case, the trader buys 1 BTC for $20,000, then exchanges 1 BTC for 20 ETH, and completes the chain of operations by exchanging 20 ETH for $20,200. Profit per operation is $200. Arbitrage with derivatives. The most complex and therefore risky type of arbitrage transactions involving the use of derivative products, including futures, options, and hedging instruments. This type of arbitrage involves buying an asset in the spot market and simultaneously opening a short position in the perpetual futures market. The main requirement is that the futures contract must have a positive risk premium. In this case, the yield is formed by accruing interest at the financing rate. This is a special mechanism in the market of perpetual futures, designed to ensure the correlation of the prices of the underlying asset and the futures contract. Funding rate refers to the fee for open long positions to traders who have short positions, and vice versa, depending on the movement of the price of the underlying asset. The financing rate is not an exchange fee and changes several times a day. For example, the current funding rate for short positions on the BTC futures contract is 1%. In such a case, an investor buys BTC in the spot market and opens a short position in the futures market for the same amount. Such a deal is neutral, and the trader's profit will be equal to 1%, which will be accrued at the time of the expiration of the futures contract. Short position. Despite the complexity and high requirements for working capital, arbitrage operations are strategies with minimal risk and practically guaranteed income. All costs and possible risks in the arbitrage process should be included in the calculations before the start of operations. A trader does not need to guess the future prices of an asset. The benefit is derived from the inefficiency of the interaction of various platforms and tools at a particular point in time. Arbitrage is an integral part of fair market pricing on exchanges. The practical benefit of such trading strategies is to equalize the prices of assets in independent markets, balancing prices to some extent. There are many obvious and hidden risks in the process of applying any trading strategy, no matter how reliable it may seem. The complexity of the calculations. Arbitrage transactions are associated with complex mathematical calculations. One wrong variable can lead to loss of expected profit, and even losses. High commissions. Due to the low profitability of arbitrage transactions, even a small commission for transactions on the platforms used can lead to a loss of funds. Low speed of trade execution. The constant volatility of the markets and the speed of transactions on modern exchanges require the trader to take almost instant action. Even fractions of a second can change the situation and break the profitable chain of speculative transactions. Technical risks. The unpredictability of the reaction of market participants and the imperfection of the mechanisms used carry the risk of non-execution of orders, suspension of trading, or freezing of the trading terminal at the most inopportune moment. The low liquidity of the asset. This risk arises from the high working capital required to generate profits from arbitrage operations. The order book may not have the required amount of funds at a certain price level, which will violate the settlement conditions and may result in additional costs. The cryptocurrency trading market is becoming more and more organized, with price discrepancies across different platforms getting smaller over time. Thanks to the centralized system of trading through the glass and information of orders, the spread, that is, the difference between the price of selling and buying an asset, is low or even minimal on the exchanges. However, P2P services may present a greater potential for arbitrage. The trading system there is decentralized. Users make deals directly and form prices, often according to individual needs. Offers for the sale or purchase of the same cryptocurrency can differ significantly. Thus, the P2P arbitrage of cryptocurrencies can provide more opportunities to generate income. Thank you for visiting Bittoro Academy. Subscribe to our Telegram channel and explore the world of cryptocurrencies with us.